making time today to come to our webinar. That's my background. If you haven't heard me before or have known about me before, I currently am the principal of Nivas Real Estate. I have had a long career in banking, particularly my last 30 years has been mostly in the financial markets area and in finance generally, and you can read all the roles there. But more importantly, I've been in a lot of industry committees over the last 30 years, to do with the Reserve Bank, to do with the Australian financial markets, and to do with the futures markets and treasury operations. So I've been also the key contact for all the banks I've worked for with the RBA and APRA. So hopefully what I would like to do today is you can see the topic on the top. What I'd like to do is to give you some real insights into where I think the market is at the moment as far as Sydney property market is concerned. I like to make predictions, so certainly I will be making some predictions as well. And I want to give you some real insights in the sense that we make our perceptions normally with what happens in the media and what the media tells us, but the media is not always, as we know, the media has not always been correct. So hopefully I can make your 1 hour with me today as insightful as possible. We will have time, obviously, for questions in the end. So I want to run through the economy, what makes the market tick. Can we please stay on mute? That'd be great. And then we'll take questions in the end. Okay. So what are some of the key considerations when it comes to property prices? What moves the needle on property prices? Now I've got my top 7 here, and it is in some sort of order. So the top thing there is supply and demand. And we all know that just about every commodity out there, supply and demand is the most important thing. So if you've got too much supply and little demand, well, you don't expect prices to go up. And vice versa, the prices do go up. So that's number 1, and we'll keep that in mind because there is an interesting dynamic actually developing in our market now, where demand is actually starting to increase, and it's going to probably shoot through the roof, and supply has got real issues. Interest rates and affordability is the second most important thing. In my view, these two things do have a big impact. Okay, as interest rates go up, affordability comes down. We know interest rates went down to below 2% fixed rates, and affordability dramatically increased. And that's part of the reason why property prices had a big jump in 2021. The factors that cause interest rates to go up, and we know this, I've been using these slides before we have had inflation, but these two factors, the RBA actually looks at them really, really closely, and they want to have a check on these two numbers to make sure that they are within the target zones. Okay, we'll talk a lot more about this shortly. Third one there is the regulator. So we have 2 major regulators that govern what happens in the banking world. One is APRA and the other one is RBA. APRA is the more important one. RBA obviously has responsibility for monetary policy, and they are the ones actually pulling the lever at the moment with interest rates. APRA, on the other hand, have got a lot more levers to pull than the RBA has. Okay. They can determine lending policy. And we've all seen that the banks are using currently a 3% buffer when they're looking at your ability to service a loan. So if the variable rate, for example, is at 5.5%, which is roughly where it is right now, then they will be using 8.5% right now to actually see whether you are able to pay the loan. Okay, you might think that is quite steep, and of course it is. 3% was pretty good when the rates were 2.5%, but then if when you were at 5.5 and they're using 8.5, then this suffers. The affordability actually suffers. So they determine that. In my personal view, when rates stop rising, it has paused at the moment, hasn't stopped. So I'll talk more about that in a minute. But when that happens, then and the next is a fall. If everybody thinks next is a fall, then you might see the RBA actually revise that down from 3 to maybe 2.5, maybe even 2. Okay, we will see. But APRA is a very prudent regulator, and that is one of the reasons why our banking system is probably the strongest in the world. No bank has ever failed in Australia. The fourth one here is the GDP and unemployment. When it comes to property prices, these two factors are absolutely key. If your GDP is going into negative territory where you are getting a recession and unemployment shoots through the roof, they're normally linked that way, okay? When GDP goes down, unemployment shoots up. If that happens, then you're going to have a very severe impact on the property prices. So again, we will touch more on that shortly. The fifth one you all know about. Post-COVID, the government has been spending significantly on infrastructure, and we'll talk more New South Wales centric on infrastructure in a second. And the sixth one here, not all of you would have been probably acquainted with this, but banks have a thing called delinquencies on their loans book. What that means is, if you've got a loan from the bank, you haven't paid for 1 month, that's not a major thing, okay? You haven't paid for 2 months, you go on what the bank calls a watch list. You haven't paid for 3 months, the bank calls it a worry list. These are real words, actually, okay? And then the bank after that starts hounding you every day. You've got to pay your loan. If not, we will possess your property and do what's called a mortgagee in possession sale. So why am I mentioning number 6 and why is it important? If we start having a lot of delinquencies, people are not paying their mortgages, not being able to pay their mortgages, then you're going to see a spike in the loan write-offs that the banks have. Okay, that can have a knock-on effect on the bank's lending policy then, and their appetite to lend to that asset class. So in the last probably 25 years, we haven't really seen delinquencies spike up much. Westpac came out with some numbers 2 weeks ago and said there's a small increase in delinquencies and we're watching it closely. Nothing to write home about, okay? It is very, very, very small numbers. So when you have a recession, and in early 1980s is the last time we had a proper recession, okay? I'm not counting the short term, we had it during COVID. In the early 80s, we had a recession and the unemployment jumped to over 7.5%. We're at 3.5% at the moment, okay? 7.5%, which means it was very difficult to find a job. We had a lot of delinquencies. We had a lot of mortgagee in possession sales. I was here in the 1982, and I could see that very hard to get a job. There were mortgagee in possession sales left, right, and center, okay? And when bank is auctioning a property, you find that there is not many people coming to the auction and nobody is bidding. So in that type of environment, it's that type of environment where property prices fall, and they fall significantly, okay? So when you hear people out there saying property prices are going to crash by 25%, 20, 30%, you've heard that over the last 3 years from a number of different people. They do not know what they are talking about, okay? You've got to have a deep recession. Unemployment is at 3.5%. So what we find in banks, and I've sat in banks' risk committees at Westpac, in a number of banks that I've worked for, and I can tell you that we do not talk much about the loan write-offs and delinquencies when it comes to the residential mortgage asset class. Keep in mind that in Australian banks, 50% of their assets are residential mortgages. That is their bread and butter. We are the highest as a percentage of a bank's balance sheet. We are the highest in terms of residential mortgages making up the asset class anywhere in the world, okay? Anywhere in the world. So in Australia, people borrow money to buy a residence, okay, whether it's investment properties or their own homes. And that number is so small that in a 4-hour risk committee meeting, we hardly talk about it for 5 minutes, okay? People may not pay their credit card. People may not pay their car loan. They may not pay their personal loan. But believe me, somehow they pay their mortgages, okay? And when unemployment is not at 7.5, it's at 3.5, it's a historic lows, people will do a second job to actually save the house. When people are telling, when the media is telling you that we will have a lot of delinquencies, a lot of mortgagee in possession sales, and there's going to be a crash, they, believe me, they do not know what they're talking about, okay? When unemployment is so low, you will have this figure in check, okay? The last factor there, and I won't dwell too any more on this because we'll talk a bit more about these things, but the last point there is the global factors. Global factors do have an impact on our property market in Australia, okay? Now, we've seen that more with sort of post-COVID, the war that has caused inflationary issues, recessionary fears in the Northern Hemisphere countries. All these things actually have an impact. They all have an impact. And at the moment, the big thing that is causing inflation is two things that we've got to really worry about at the moment. One is our rents are going through the roof. That is a local factor. And the second factor is oil prices are spiking up again. Those two things we've got to watch very, very closely. I don't know why OPEC has actually stopped. Sorry, they've cut their production in this last week, and that has spiked the crude oil prices to actually go close to $90 to $100 again. Okay, so what has been happening here? The current numbers, surprise, surprise, Sydney is actually showing on a rolling monthly basis, showing some increases in the last month, okay? Most of Australia in the last month, reasonably flat, okay? You got houses and apartments, but Sydney is sort of bucking the trend a bit. And, there is some strong numbers still in Adelaide. But 3 months ago, even 2 months ago, nobody was actually saying that we could see a small jump in the house price. Why? Because everybody's been telling you that interest rates are going up, inflation is going up, cost of living is going up, people cannot afford to buy a house. So what happened? We'll talk more about that in a minute, okay? Now, we've talked about my 7 top factors that move the needle on property prices. This is some of the recent news, left side negatives, right side positives of what, again, has an impact on the property prices. Just recent news, okay? So there's been a mini banking crisis. The Silicon Valley Bank actually crashed. Credit Suisse had liquidity issues. Both issues have been resolved now, but it caused shockwaves around the world. So one issue like that can cause shockwaves. What that caused actually is the bond and swap rates to come down significantly. And I'll show you a graph on that without talking too much about it right now. The second one is the RBA has paused. We've been talking about a pause. I've been talking about a pause since last November, and finally they have done it, okay? And part of the reason why they paused was actually because of this top factor here, that and a few other factors. But I won't go through all of them, but you can read on the left here some of the things that are negatives. And on the right side, we've got a new policy now. New government has come in, Labor government has come in. And a lot of people ask me, what does that mean for the property market? Will it have an impact? Well, here's one positive impact already, okay? The threshold, they're going to, from 1st of July, they're going to increase the threshold to 800,000 for first home buyers with 0 stamp duty, and up to $1 million for a reduced stamp duty. So first home buyers, that limit was at 650, okay? So that gives a bit of reprieve to first home buyers to buy something for 700, 800, and even 900 and $1 million, and at up to 800 not pay any stamp duty at all. So that might cause a bit more activity with first home buyers. On the other hand, we've got a rental crisis like we have probably never seen for a very, very long time. And I've got some graphs on that, so we'll talk about that. Unemployment, like I said, very, very low. Migration, these numbers, we talk about it as well. GDP is still, listen, our economy is still strong, okay? Key is our economy is still strong. Now, this is some of the news making headlines in the last week. So the big news is nobody expected that we're going to get 650,000 new migrants in the, so have a look here, okay? 195, okay? Now we're talking 650,000 in the next 2 years. It's unprecedented. We have never in our history seen so many people coming to this, to our country in such a short period of time. And they're coming at a time when there is a huge housing shortage and a rental crisis. Then here we're talking about bucking the trend. So Australian property prices 2 days ago bouncing back despite rising interest rates. So how did that happen? ING has started to cut its fixed rates, and yesterday ME Bank actually cut its fixed rates as well. The Chris Minns overhaul we've just talked about, and our annual inflation rate. So the last inflation rate that just came out a week ago, it's lower, so it's at 6.8%. But this is a monthly rate and does not take into account all of the CPI numbers. So it is an indicator that we have peaked, okay, and now we are heading in the right direction. When will the real numbers come out? At the end of April, end of this month. So just a recap of what happened in 2022. We thought we've come out of the lockdowns, we've come out of COVID. Now everything should be sweet. Everything will go back to normal, and all of these things happen. Okay, I won't go through all of these, but I'll let you quickly have a read of it. All of these things happen in 2022, and that's why we are where we are today. Okay, and we've had 10 interest rate increases. But that's history. Let's move forward. Now, every time I do a webinar, and I've been doing this now for a number of years, I keep telling everyone, and more so right now when we are at 3.6% interest rate, I keep telling my listeners that the average cash rate in the last 33 years, since January 1990, when it was 17%, all this time here, the average is actually at 5%. So the average rate, if the average rate in the last 33 years is at 5%, why are we making such a big noise at 3.6? Well, the reason why we're making a lot of noise is for two reasons. I keep saying to my listeners, we are still in a low interest rate environment. So here, this graph doesn't show, but this one shows the steep increase we've had here. So this fall here was because of COVID. It was what I call the honeymoon period. We should never have gone to 0.1. We should have parked ourselves somewhere here, okay? And then from here to here is not such a steep increase. But because it went down to here, even if inflation did not go anywhere, even if inflation was under control, do you think the RBA would have left the cash rate at 0.1? Absolutely not. Absolutely not. So either way, we would have come to 2.5. Either way, the cash rate would have come to 2.5. This line here is where the RBA wants the cash rate to be. So between 2 and 3 is where the whole world wants the cash rate to be, okay? And the whole world wants the inflation to be between 2 and 3 as well. But inflation overshot in a short period of time because of all the global issues, the war, the shipping costs going up, and the shortage of supply and so on. So we're at 3.6 at the moment, okay? Are we too far away from 3? This is the band the Reserve Bank wants us to be, between 2 and 3. Are we too far away from it? No, we're not. We are absolutely not. And I think if there's one takeaway for you today, that please keep in mind, we are still in a low interest rate environment. So when you see property prices suddenly jump, right? You say, well, how did that happen? We are still in a low interest rate environment. I have paid 17.5% interest. I have paid 10%, I've paid 9%, I've paid 8%, okay? Throughout the 40 years I've lived here. So this is this journey we've all lived, okay? People who have been buying properties here for more than 10 years, they have lived that journey. So we had this very low period here, and we are here at the moment. Will it take us long to get back here? Probably not. Probably not. Now, inflation, as I said, is peaked in the December quarter here. These are December quarter numbers. We only get CPI quarterly. This is now the monthly figures are showing us that it is trending low. It's at 6.8. We hope that at the end of April, when we get the March quarter numbers, we want to see that number somewhere around that 6.5 would be good. The Reserve Bank would be very happy with that, because from 7.8 to 6.5 is progress. Okay. Then by the June quarter, if we can see it come to 6 or below, that is going to be amazing. This is the other thing the Reserve Bank wants to see. You don't want wages to grow too quickly. If wages grows too quickly, which it can when you have got an unemployment rate of 3.5%, then what happens is it causes inflation to go up. So we need to keep wages in check. So we've got a shortage of labor. We've got 500,000 vacant jobs in Australia at the moment, unprecedented. We need the 650,000 people to come here and come here quickly so that they can take up jobs, so that they can pay tax, so that we can pay our pensioners, so that we can claim, we can pay for Medicare and we can pay for aged care. Okay. So I won't dwell on it. There's not an economic session, but RBA has now paused. Where to from here? So the March quarter figures out in April is the key. If 3 figures, okay, so inflation, absolutely key, GDP, absolutely key, and retail sales, these 3 figures are absolutely key. If retail sales goes down, especially the non-essential goods, so please, everybody listening today, if you want interest rates to go down, stop spending on non-essential goods, okay, stop going shopping, buy your food and clothing, but not anything else. GDP, we've got to see this figure come down. The reason why GDP is still actually rising and rising really slowly is because we're getting so many migrants, so many students, and they've got to consume goods. They spend money, and that keeps the GDP going. When you minus the migration, that GDP growth number actually slows down. So we need to see inflation come down, GDP come down, retail sales come down. If these 3 figures come down end of April, they will pause again. If these 3 figures are not good, okay, you may see another increase in May. Unfortunately, that is the truth, okay? This pause is not the end of the interest rate increases. In my personal view, the lag effect of such sharp increases in interest rates is going to have a detrimental impact on GDP and retail sales. I hope so. And therefore, I hope that this is it and there's no further increases. So then there's the global factors. We saw the banking crisis, and I won't have time today to go through why it happened to Silicon Valley Bank and what happened to Credit Suisse. Right? These are things that can become ugly really, really quickly. Will it affect the Australian banks? And I get asked a lot. It will not have any impact on the Australian banks. Because why? Because APRA is the best regulator in the world, and their policies with banks here, with liquidity and with capital holdings, is above what we call the global standard, which is set by Basel. So there's a thing called Basel III, which is set in Belgium, and that is for global banks. And we are above where Basel sets the hurdles, okay? Now, this is probably another very, very important takeaway for you today, to understand interest rates. The left side here is what I showed my listeners on 9th of March. It's called the cash rate futures implied yield curve. What this shows you is what the money market thinks, what the futures market and the money market thinks will happen to interest rates. So you've got interest rates here and you've got time period here. So we thought the cash rate is here, right? The cash rate is here, the blue dotted line. So the money market thought things are going to go up. So by August, go up September, go up, go to 4, slowly taper off. By mid next year, taper off, back down again and come down. And just ignore the right side for another 5 seconds. I told my listeners that you will find that as soon as there is a pause, and as soon as we come to the second half of this year, that this graph is going to fall down a lot quicker. Why is this graph important? This graph sets the fixed rates. Remember, we said ING. Why did ING and Me Bank act quickly? Bond rates and swap rates came down. They went and locked away some risk, and they're able to actually offer lower fixed rates. Guess what? Because of this mini banking crisis we had, the bond rates, the futures rates, and the swap rates all fell really, really quickly. So on 5th of April, this is like today, this is the graph. I expected this to happen in the second half of the year. It's already happened, folks. It's already happened. Okay. So now the money market thinks, here's the cash rate. Okay. By September, we're going to be below, which means the fixed rates. This is telling me the fixed rates in September, October, November, December is going to be below the cash rate, below the variable rates. Okay. Reserve Bank does not set fixed rates. The banks set fixed rates. Who set the fixed rates at HSBC when I was there? I did. Okay. What we do is we create a yield curve based on the futures price, the bond prices, and the swap prices. And what we do is we predict what is going to happen in the next 1, 2, 3, 4, 5 years, and then we set the fixed rates for the mortgages based on that yield curve. Now, it's already happening. All you need is some real bad numbers to two things. Some really bad numbers to come out, whether it comes to GDP or so on, and you need to, if the money market thinks that the pause is no longer a pause, it's the end of the interest rate cycle, and the next interest rate is actually going to be down, not up, this will fall further. This will fall further. Okay. So watch this space. I show this every single time now so that my listeners can understand that fixed rates, I am predicting in the second half of this year that fixed rates are going to be somewhere around that 4.5%. Variable may well still be at 6, but fixed rates are going to be, could be even 4 to 4.5. Okay. You know, the fixed rates move faster than the variable rates. So when fixed rates went down to 1.99, you all remember that, 1.89, and some people fixed for 2, 3, 4 years. The variable rate was still at 2.6, 2.7. The same thing is about to happen again. Nobody's talking about this at the moment. They're all talking about the cash rate, okay? But when fixed rates have a meaningful drop, not 25 basis points, but 50 and 75 basis points, then people will be focused on that. Please keep that in mind. Do interest rate increases crash properties? No, it doesn't. Okay, no, it doesn't. So I'll rewind very quickly to here. We had one interest rate increase here, 94. We had another one here, number 2, in 33 years. Okay, number 3, a long prolonged period. Number 4, these 4, and then now we've got the 5th one. So come back here. So this is the history. I won't dwell on this either because of time, but 1 year after the cash hikes completed. So if this was the last hike, from now, 1 year later, 2 years later, 5 years later, what happened with the last hikes? 2.75 up in that period, 0.3% up after 1 year, 2% up after 2 years, 26% after 5 years. And then, and so on and so forth. Okay. None of this is a crash. My point to you is those people who are talking about a 15, 20, 25% crash in the property market do not have a clue. Please do not take media at face value. I showed you that our economy is strong. Our unemployment is at 3.5. Delinquencies are low. How are you going to have a crash? If there is a mortgagee, I'm not saying there won't be mortgagee in possession sales. If there is a mortgagee in possession sale out there, right now, pick any suburb in Sydney, I assure you when, let's say, ANZ announces mortgagee in possession sale auction, there will be 100 people there. Everybody will be bidding. And you know what? They're probably going to get a market price or above market price. So when you got that type of market, there is not going to be a crash. Okay. So what's happening in Sydney? Very, very quickly, again, what is happening in Sydney? Sydney is going through a major transformation, a once in a 50-year transformation. By 2036, we're going to get another 2.7 million people coming to Sydney. Okay. So 8 million people will be living here by 2054. That is massive. Why do you think we have so many infrastructure projects happening in Sydney right now? These are, by the way, these are not my numbers. These are New South Wales Treasury numbers. Why are we having so many tunnels, so many roads, so many schools, so many hospitals being built, expanded, metros being built, airport being built? All of this infrastructure is going in. It's to cater for this. It's cater for this, okay? Come what may, this will happen. Every single year, Sydney needs, in a normal year, okay, this is not normal. Next 2 years is not normal. Not normal because of the number of people coming here, okay? So you see this up here, 60,000. A lot more people are going to come here. On that, we need 38,000 dwellings in a normal migration year. 38,000 dwellings a year we need. There is no way in the world we're going to get we're going to build 38,000 dwellings per year. And I'll come to that in a minute. The government is doing a lot now, but too late. It's too late. So we've got a shortage. That's why we've got a crisis at the moment. So we're spending billions and billions and billions on infrastructure, which will keep our unemployment in check, will keep our GDP growing, and the demand keeps growing, and people are coming here, okay? Now, I call this the perfect storm for apartments. And I have been saying this probably for the last 12 months or slightly longer than that. And to be honest, and I'll be honest, I get things wrong as well in terms of timing. It hasn't happened yet. It has not happened yet. So when we were due to happen 12 months ago, what happened? Inflation shot through the roof. This was supposed to happen January last year. It was a perfect storm in January. What happened? Inflation shot through the roof, and we've had 10 interest rate increases. That put a brakes on this. But now I am more bullish than ever on apartments. And I have 7, I like the number 7. We have 7 strong reasons why apartments are going to go up significantly in the coming 12 months to 18 months. Number 1, we are due for a rise. The gap between house prices and apartment prices has actually widened further than it has ever done. So apartments are gonna have to bridge that gap. That's number 1. The migration numbers you saw. That migration number. So the reason why apartments were actually not in vogue in the last 3 years is mostly because migration stopped. The expatriates were not coming here, students were not coming here. And now what is happening is the opposite is happening. There's significant foreign buying activity coming back, mostly driven by the Chinese. There is migration going through the roof, students are coming, and the investor returns are creeping up because rentals are going up. Third reason, supply. Remember, demand and supply was my number 1 reason. Demand is going to be stronger than it has ever been in the next 2 years. Supply is significantly down. So I won't go through each bullet point there, but I want to show you this graph now. So apartment completions. This is apartment completions in Melbourne, Sydney, Brisbane. Okay, 3 big markets, Sydney being the biggest market. In 2022, we had 14,000 apartment completions. Now, what happened in 2023 is going to fall to 9,600 completed apartments. And in 2024, only 4,500. Why is that? During 2020 and 2021, it takes 3 to 4 years to develop apartments. By the time you buy a site, by the time you get your DA approval, by the time you do all of the work you need to do, it takes 3 to 4 years. So we stopped for those 2 years. This is logical, right? 2020 and 2021, we stopped. So the apartment completions in 23 and 24 is coming down. At the same time, the demand is actually going through the roof. Demand graph would be going like that, and supply is coming down. That is, if you don't see any other graph today, that is one of the strongest reasons why apartments are due for a jump. You see this graph here. This is how much in 2021. This is how much houses went up. This is how much apartments went up. That's why that gap got created. Okay. Another graph here where you see in a 30-year period. See, mostly apartments are blue and the houses are red. Mostly they move in tandem. But see this gap here. This gap has developed in the last 3 or 4 years. It's a big gap that has to be filled. Okay. So coming back to number 4 now. Rentals are heading up and up. So if you live in Sydney and you're listening to me, you would know that it's impossible to rent a property now. So they're moving rents, so you're paying 500. Suddenly, next when your lease comes up for expiry, you're now paying 650. That is the story that you're going to keep listening. This will be headline news for the next 2 years. This is the biggest issue our government is going to face, not climate change. It's going to be rentals, okay? Rentals and the chronic shortage of properties is what you're going to hear in the news for the next 2 years, every single day. You can't overnight create apartments or houses. You can't. So that is a big story. Affordable. So if you think rentals are already high, you wait for the next 12 months, it's going to be up another 20 to 25%. So if you're paying 600 now, you might be paying 800 in 2 years. You can write it down. It is going to happen. Okay. Until that supply comes, you are not going to see rentals go down. People are going to sleep in the cars like they are starting to do in Brisbane and Perth. Okay. Affordability issues. You know there are affordability issues. But affordability issues are mostly relating to houses, which are becoming highly unaffordable in Sydney. And then you've got people who are having lifestyle change. There's more downsizes. They will be pushed more towards the apartment space. And because there are fewer and fewer apartments in the next 18 months, you'll find the prices have to only go up. And then I talked about the stamp duty savings now. The first home buyers, it'll fuel the first home buyers to start coming back in the market. And last point is to do about the economy. You need a strong economy and you need infrastructure spend, you need jobs. All these 7 factors are the perfect storm for apartments. Okay. Shown you those, so I'll go skip past that. So suddenly the government decides, okay, we've got a crisis, very knee-jerk. We've got a crisis, we've got to solve it. So they are now accelerating approvals for 70,000 land zonings, 70,000 lots. So a lot of land zonings happening in the northwest and in the southwest of Sydney. Too little, too late, because again, a property developer, you get zoned today, you apply for a DA, it takes 1 year. Then you develop the land another year. You're at least 2 to 3 years away. Okay. So the government is very knee-jerk. They should have predicted this post-COVID. This should have been released. More rezoning should have happened a lot earlier. So I said I'll talk a little bit about rents. Rents are actually going up. So you can see here, Sydney, you've come from here, and now we are here, right? 19.2%. And then you've got apartments down the bottom here. Apartments in Sydney have gone up 24.2%, houses 19.2%. This is a massive jump. And it's only going to increase further. It doesn't help our inflation, by the way, this rental increases. So this is the vacancy rates we are seeing. We're seeing national vacancy rate at 0.8. The March numbers are not dissimilar, so I haven't updated it. but 0.8 nationally. Okay, Sydney is 0.9. Where was Sydney during COVID? It was 3.9. 3.9. We're now at 0.9. So the chronic areas in Australia, Perth 0.3, Adelaide 0.3, Brisbane 0.6. These are chronic levels. Sydney is soon going to be like Brisbane 0.6. And who knows, it could get down to 0.3 as well. So this is a crisis. This is a major issue, okay? So in a very simple graph, what I have talked about, Sydney's story for property 5, 10, 15, 20 years from now, you are going to see economic growth continue. Economic growth will be fueled by the huge migrant and student intake we're going to continue to have over the next 2 years. That's going to keep our economic growth in check. Jobs growth will continue because as the economy grows, the jobs grow, people will keep hiring people. The 3.5% unemployment cannot be sustained with so many people coming here. You will find that the 3.5 will probably slowly creep towards 4 and then slowly creep towards 4.5. Is 4.5 bad for unemployment? Well, I've lived through 7.5. It was 5 before COVID, okay? So 4.5 is still very, very healthy. 3.5 is unhealthy, it means everybody is employed, nobody to do any jobs. And then you've got to see that's going to jobs growth, wages growth, population growth, increased rental and buyer demand. All these things, very simple graph to understand, increases property values. This trend is going to continue in our city for the next 5, 10, 15, 20 years. It's not going to stop. Next big thing with property is where do you buy, what do you buy, when do you buy? Okay, location is very important for those reasons I've mentioned there. You've got to have infrastructure. You've got to have population growth. No point buying an investment property somewhere where there is no population growth. Population growth and the type of people who are going to go there. Job creation in close by. Those things are the key. You see where they are opening a Bunnings. You see where they're opening a Costco. Okay, you see where Coles and Woolworths are opening up. They have so many more research people than I have. They've done their homework. You just follow where they're going and you can't do badly, okay? The people who live in Ponds and Marsden Park and those areas and Edmondson Park and so on, they will tell you what infrastructure is coming and already is there and how much their values have increased. Price is very important. You got to buy a property at wholesale price. You might be saying, what's this guy talking about? What is wholesale price? Okay, I'll talk about wholesale price in a minute. You should never pay a premium for a property. Whenever you're building a portfolio, you got to buy at the rock bottom price. That's where we come in. We have hundreds of different development opportunities that we can show you. We value pick the best ones and only show you those. Timing is important. Timing is important right now because I'll tell you why, right? I talked about the apartments. What I haven't told you is every week we talk to developers. Every single week we talk to property developers. So we had 2 meetings with very large property developers this week. And they're telling us, listen, as soon as the demand increases, all our rebates are going. We've got rebates, they're all going. The 5,000, 10,000, 20,000 discounts, all going. And on top of that, we're going to increase prices by 5%. So if you've got a 5% rebate on a property now, in 3 months' time, if what I'm saying is correct, you already made a gain of 10% in 3 months. It is possible, okay? It is highly probable. And then who the developer and builder is becoming very important. So the thing is that we've been talking to these apartment developers. A 2-bedroom apartment in Sydney used to cost $250,000 to build. This is what developers tell us. All of them are on the same page. It slowly crept up to 280 and 300. Guess what? One property developer told us this week that now it is impossible to do a 2-bedroom apartment under 380 to 400,000. 400,000. That is a massive jump. Is that reflected in the current price? No, it's not reflected in the current price yet. The reason is because the market has slowed down. As soon as this market turns, and we're seeing all those headlines in the last week that I showed you, the market is going to turn. The market is going to turn. What is going to fuel the market turning? 1, demand. 2, high rentals. 3, fixed rates coming down. Those 3 things happen in tandem, you see this market take off again, okay? So that's very important. And now I won't go through each of the bullet points here, but I'm going to show you a product in the northwest of Sydney. And this is what's happening in the northwest of Sydney. So New South Wales GDP, keep in mind, is bigger than these countries, Malaysia, Singapore, Hong Kong, bigger than those countries. Western Sydney, which includes northwest of Sydney, is the 3rd largest economy in Australia. So I would actually go as far as to say, in the residential space, the northwest of Sydney is the fastest growing in all of Australia. Okay, it's going to be bigger than Canberra in 8 years, the northwest precinct only. There's a new airport coming. The metro is going to go to the new airport. There's a new metropolis being built, one metro away from the Badgerys Creek Airport. If you don't know what this is, please Google it. And then you've got more job creation happening in this area. So population growth is going to go through the roof. I won't dwell on auction results, but you've all seen last weekend, Sydney was at 73.3. We've been tracking quite well recently, okay? So how come with interest rates going up, everybody predicting a crash, and the auction clearance is actually increasing, the number of properties on auction is actually increasing? I have been saying this for many, many, many months. Do not believe the media. So listen, I've made some predictions in the past, and fortunately, I can't be right all the time, but these have all come true, and people have fixed their rates. So those of you who are listening and you're thinking, okay, ING and Me Bank have dropped their fixed rates. Should I go rush to the bank and fix it out to 5 years? Please don't do that. Please do not do that. Fixed rates are coming down more, okay? Don't go and fix a 5-year rate at 5.5% today. Do not do that. Wait until it's 4%. Then I would say, I will tell you when to do it, okay? Because it's coming down. It's going to come down quickly. Now, some of my predictions, I did say cash rate will peak at 3.85. So I'll still stick with that, okay? I'll still stick with that. Knowing the RBA and the way they have behaved recently, I'll stick with that. It's another 0.25% to when it'll happen, I don't know. It could happen in May. It could be a little bit later. Depends on the numbers. Stop spending and it won't happen. Inflation, I reckon, will fall to 6% by June, 4% by December, and 3% by June 2024. These figures are very aggressive from me, very aggressive. I think it can happen. The thing we've got to watch is the oil prices, and we've got to watch the rentals. That's going to be the biggest factors that are going to weigh on this inflation number. I don't think we're going to have a recession. The consumption from migrants, visitors, and students is going to be so strong that they'll keep our economy ticking. I reckon the RBA could cut rates in September to December period. And as I said, I think fixed rates will be 1% or more below variable by the end of this year. Unemployment to go up. Some of my predictions. Now, to the project, very, very quickly, conscious of time. We have picked this project because 1, it's the location. 2, it's the builder. Okay, so I'll just run through it quickly. It's at 41 Terry Road in Rouse Hill. Rouse Hill, one of the most sought after suburbs in the Northwest. There are apartments in townhomes, not multi-rise. It's sprawling, no higher than 5 levels. Binar Group, a reputable builder, is the builder. Rothelman is the architect. It is a very unique development. Denville Group is the developer. They have been around for a while. They bought this land in Rouse Hill a long, long time ago for a song. So the land is paid off. You've got no developer risk. They've got the loan to do the development already. And they have come to us a couple of weeks ago and said, we are going to discount this project. Binar Builders, as you can see, some of their projects here, they're a reputable builder. They know what they're doing. Now, there is a lot of greenery because if they want to build this like Babylon, So they have hired one of Australia's best landscape person, Mike Horn. I don't profess to know him, but I am told that he has done some very, very major projects and knows how to green up buildings. Okay, so we will see what I'm talking about in a minute. Location is here. So location is, so this is Rouse Hill Shopping Centre here. This is the new Rouse Hill Hospital. The biggest hospital to cater for the northwest of Sydney has just started construction. By the time this finishes end of next year, this project, so will the hospital. So perfect timing. You walk from here to the hospital, 10 minutes walk. You walk from here to the metro, 15 minutes walk. Okay, there's one metro here. This is Rouse Hill Metro. There is one metro here, which is Tallawong Metro, almost equidistant. But there is 2 minutes drive, basically. Okay, so excellent location. Now, just some statistics there, and I'm not gonna run through all of this, but the main thing is we're forecasting a population growth here by 250,000 people by 2036. There's a 300 million expansion happening to the Rouse Hill Town Centre. It'll be, if you've been to Rouse Hill Town Centre, it'll be 1.5 times that size, which is massive. Okay, so more than 240 stores in the shopping center. There's a 3 billion plan to transform Nivas Business Park, which is only like 3 metros away. Okay, stops away, literally 7 minutes in the metro. And the Hills District is set to become Sydney's economic hub. So all these factors tick my boxes. When I look for a location and I say to my team, does it tick my 10 boxes? If it ticks 8 or 9 of my boxes, 10 boxes, then I say this project is worthwhile. If it ticks only 5 of my 10 boxes, we don't touch it. And I can show you 30 other projects in Sydney that I'm not presenting to you today. Now, this is what it'll look like, okay? There's no swimming pools. There's lots of beaches. It'll look like Babylon. This is not a swimming pool. These are just water features, okay? So all of this work, all of this planting, all of this will be done by the landscape. The developer will do all of this. These have 3 different types of residences. In the middle here, you've got a normal apartment. On the top, you've got 2 levels. You've got one level here they call sky terraces, and you've got your own sky terrace up the top. The bottom level has got what they call garden terrace, and the garden terrace is 2 levels. So you've got your garden terrace here, and you've got 1 level up. Okay, so just to give you an idea, this is not a single one. This is a common one, but I'll show you a single one number. Now, one of the key things I'm going to say about this project is the level of finishes. Apart from the look, see, feel of what you saw in the common areas, and it'll stand out as a project. The internal finishes are second to none. In fact, I would say the best in the Northwest. So you've got ducted air conditioning throughout. You've got marble bench tops, not scissor stone, marble bench tops, marble splashbacks, 2.7 ceilings, timber floors, same in the bathrooms, okay? It has got amazing finishes. You've got plush wool carpets. These are not your acrylic carpets. So when you're looking at the courtyard ones, you've got double ceiling height. You've got your own private courtyard, okay? These stand out from your normal 2-bedroom apartment. I mean, I don't have to say more. So this is an example of your own private rooftop garden. Not many apartments give you that. Now, the great thing is, you might be thinking now, well, of course, you got to pay a hell of a lot of money for this. No, the prices are actually in some cases cheaper than just a normal 2-bedroom apartment in Rouse Hill. Why? Because they are doing a special rebate at the moment. As soon as they've sold about 30 or 40 out of the 350, as soon as they're sold about 40, the rebates are gone. We've got a 5% rebate at the moment, which is really, really aggressive. So this is an example of a 2-bedroom apartment with its own private rooftop, okay? So a decent size apartment, good floor layout, no wasted space. Then you've got another 2-level one here, which has got like a ground floor courtyard. Then you've got a couple of bedrooms, and then you've got your upstairs dining and lounge. Here's another one with a roof terrace, and and a ground terrace both. So these are some examples of floor. Here's just a normal apartment, okay? Just a normal apartment. So you've got your 1-bedroom apartment, you've got a good sized terrace there, and living space there. So from a price perspective, this is what I call wholesale prices. When your developer says, I'll give you a 5% rebate, they're going to take these rebates off in a couple of months, or as soon as, whichever comes first. 1-bedrooms are starting from $499. There is nothing in Rouse Hill at 1-bedroom $499. 2-bedrooms are starting from $629 after the 5% rebates. Now, you can buy a very, very, very decent 2-bedroom apartment in here for between $650,000 and $700,000. And I can tell you that the competition around does not have any of those finishes that I'm talking about, and they are at $720. So this is one of the best projects that you can get into today. We've got a window of opportunity for this project. There are only 2 agents on it. The developer is very blunt with us. He said, you are the Indian agent and we've got a Chinese agent. There's only 2, okay? The strata is low because there is no swimming pool, there is no gymnasium, there's no tennis court, there's none of those things. So it's good for rental returns. Rental returns are very, very, very strong. So with strata, don't worry about the 250, that's a studio. But for strata on a 1-bedroom, 650, for 2 bedrooms, 650 to 1,000. These are very reasonable strata, okay? I pay for some 2 bedrooms that I own, I pay around $2,000. So you're going to have low strata. Rentals, these are today's rentals, okay? So today's rentals, 1-bedroom, 2-bedroom, 3-bedroom, already quite strong numbers. But by the time this is complete, by the end of next year, these numbers are going to get more compelling. Much, much more compelling. So you're going to be probably seeing about 6% returns. So I'll end there and take questions, and apologies for going a little bit over time. I wanted to finish 10 minutes ago. Please do not follow the media blindly. Okay, do your due diligence and speak to experts to know where to buy. I have seen so many examples over the last 5-6 years, people buying 2-bedroom apartments in Rhodes, in Lidcombe for 900, $1 million, and the prices have not gone up. And they say, well, what happened to me? I said, well, you paid a premium and you bought the wrong property at the wrong time. You got to have a long-term view when building a portfolio. That is absolutely key. It's not the stock market you buy today and you sell in a week. You've got to build a portfolio where you're buying at the right price. You've got future potential growth. Rouse Hill, believe me, is going to be a suburb where there is so much happening that if I give you an example, so you buy a 2-bedroom apartment here for say 670, 680. 5 minutes away in Norwest. In Norwest, a 2-bedroom apartment is at $900 to $1 million. $900 to $1 million. Okay. Castle Hill, $900 to $1 million. So you don't have to be a rocket scientist to work out that this area is definitely got huge potential. You're closer to the new airport than Norwest and Castle Hill. Okay, 3 stops closer. And I finish off by saying, if you've paid off your house, and you've got $1 million in the bank or in your super, can you retire on that? The answer is absolutely not. The bank today will give you 3.5% interest on $1 million. That's $35,000 a year. At $35,000 a year, none of you listening to me can survive. Okay, and that is when you retire. Okay, that is when you retire, when the cost of living will be a lot higher than what it is today. So my point to all of you is you have got to invest in properties. You have got to find the right properties to put money into. The good thing about apartments is that with something like Babylon, you pay 10% now. So let's say you buy something for 700, you put 70,000 now, don't have to pay a cent to the developer until end of next year. three things are going to happen by then. Rentals are going to be up, your value of your property is going to be up, and your interest rate will be down. If all these three things happen, you have already got equity in your property, or you have got a good return happening, and your borrowing power will be higher and your borrowing cost will be lower. Okay, Australians are per capita the richest people in the world. The only reason for that is because we buy properties and property values only go up. Believe me, by 2030, there will be no two-bedroom apartments in 2030 below $1 million in Sydney. There will not be any. I'm talking about brand new properties. Okay, there won't be any. And if I told you that apartment prices have actually doubled in the last 8 years, you might not believe me, but that is a fact. So you could buy in, I'll give you an example. You could buy in Blacktown a two-bedroom apartment for $260,000. 2014. Now the same apartment is $550,000 brand new, not $260,000. So what I'm saying is going to continue to happen. The demand right now, we are in a very good spot where property prices are going to go up because interest rates, doesn't matter what anybody tells you, we're in a low interest rate environment. I'll stop there and I will take some questions. Hopefully that was useful for you to spend your time with me today.
Thanks for that, Sachin. Great session. Amazing. Okay. Now, I've just got a few questions here. Question number one from Zoom user. With so many builders collapsing with supply chain issues, how can the people remain immune from getting affected when entering into new contracts, which are off the plan?
Okay, good question. Good question. And we have had in the last 2 years more home builders going belly up than we have probably seen for a very, very long time. Okay. The main reason for that has been mostly the home builders and some apartment builders who have locked their price. And suddenly, when you've got a house and land package, for example, fixed price, full turnkey fixed price, and prices of goods go up 30%, labor goes up 30%, then you can't deliver, okay? And they only get their money when they are building, okay? So that is the reason why. You need to have very good CFOs telling you not to overcommit on that type of stuff. Those that had contracts that you could amend vary the price, they were okay. Here we have got so that is a very good point, because here we have got a developer, the land is paid for cash. They paid cash 30 years ago. They probably only paid $300,000 for the land. So now they've got their finance already. The finance is already done. They have already got they don't need the sales to get finance. The project is actually starting right now. So we know the strength of the developer. We know that they have got the loan, and we know that they're going to make a profit. No developer wants to do a project without a profit. So we talk to the developer directly, and we actually said to them, why are your prices so low for the quality that you are representing here? Say, no, we're just going to do this for the first few sales, and then we're going to push the price up. The word is, don't worry, we're making plenty of profits. Okay, so that is the exact words. Do not worry, we're making plenty of profits. And believe you me, that by the time the last 100 apartments are sold in this complex, the prices are probably going to be somewhere around 80 to 100,000 more than what they are now. Okay, but hopefully I've answered your question.
Thanks for that, Sachin. Okay, next question. What do you predict about Blacktown, Sydney, with the recent announcement of the revitalisation project in Blacktown CBD?
Blacktown is an excellent place to buy an apartment. Blacktown is an excellent place to buy an apartment. Okay. Again, pick the right price, pick the right project We have projects there as well. Okay. And you know, Blacktown is very well positioned, comes under this northwest precinct as well, and absolutely nothing wrong with Blacktown. I'm not gonna, you know, I'm not gonna push you into one project, but if I were given a choice between something in Blacktown versus this, I would pick this. Okay, we have projects in Blacktown, so we can take it offline and talk to you about the projects we've got there as well.
Perfect.
I
Thank
have
you.
a question.
Sure.
Can I
Um,
ask?
Yeah,
Of course,
for
Meenakshi,
sure.
go ahead.
I'm Meenakshi, and I've seen that the Parramatta is already grown up and it's expanding. So, what's the future of Harris Park?
Future of Harris Park?
Yeah,
Yeah.
is it
listen,
going to be overtaken by the Parramatta? Like, is it worth buying an old apartment in Harris Park?
listen again, it comes down to the price and what you're buying. Sometimes what can happen is you buy in some place like Harris Park, and you're buying an old apartment, and a developer comes, and it's like 3 stories up high. Developer comes and buys out that apartment block because they're going to put 25, 30 stories there, and they can offer you maybe $200,000 more than the market value for your apartment. So there can be opportunistic buys like that. If you're buying as an investor, then we actually prefer to advise our buyers to buy a new property if you're an investor, because you get the full depreciation, you get better tenants, you've got low strata for the next first 5 years. So there are some, and we can discuss this offline in terms of buying secondhand properties versus new properties. We've done separate presentations on that, and we can share knowledge on that. So please feel free to reach out to us offline, Meenakshi, and we can certainly assist you in that regard. We are also a buyer's agent, and we can search for properties for you as well.
Thank you. Thank you.
Thanks, Meenakshi. Thanks, Sachin. Okay.
Parramatta has had a long period of lull and a bit of an oversupply issue. That issue is going to go away quickly. So if anybody listening owns a property in Parramatta or owns an apartment in anywhere in Sydney, my advice to you is don't take the past as your future in terms of predicting price. We are due for a big jump. Okay, we're due for a big jump. So hang on. Do not sell your apartment. If you've done nothing in the last 3 years, don't worry. Okay, but do not sell. If you don't have to sell, do not sell. Buy another one. Okay.
Awesome.
I have a few questions I'll discuss with you offline.
Please, offline, certainly. You hopefully have our contact, but Krish can.
I'll share that in a moment. Yeah, definitely.
I can share. Sorry, I'll just quickly share the numbers there. You can see that.
Yep. Awesome. If you want to take a screenshot of that, guys, feel free. Okay. Now, the next question was a direct question to myself. So this is from Jeet. Is it worth buying a $600,000 apartment now as an owner-occupier in Blacktown and making it an investment later on? It's more personal, I think. Yeah. Thanks. Good question, Ajit.
Listen, it's a personal question. Sorry, who raised the question?
This is Jeet.
Jeet, it's a personal question, and it depends on people's personal circumstances. So we a few quick things for you. So if you buy a apartment now, you take advantage of your first home buyer type advantages, live in it for 3 years. The capital gain in the 3 years will not count. If you then in 3 years' time, for example, make it an investment property, if you at that time make it an investment property, take a valuation at the time, that was your principal place of residence. When you make it an investment property, from that time on, you will be, any increases after the 3 years, you'll have to pay capital gains tax. The second point I'll make is the loan that you have on your property. You cannot increase the loan amount when you put it on, make it an investment property. So if, let's say, you're putting in a couple of $100,000 cash and you're borrowing the rest, if you make it an investment property, you can't sort of say, well, I'll just increase my my borrowing now because I'm going to get an interest deduction on my loan. You can't do that. Okay, you cannot increase it because you just change your direction to a investment property. But I can take this offline and give you a little bit more insights on the pros and cons of doing that. So please feel free to reach out to us. By the way, we don't charge for our time to help our buyers. We want our buyers to actually buy properties, build a portfolio, and create wealth. And so this is why I do this, because I enjoy doing this, right? And I think building a portfolio is great. I've done it over the years, and now I want to help others to do it. And the thing is that if the more properties you hold, when you have a 2021 year where property prices went up so much, then if you hold $5 million of properties, you go up 10% even, you make $500,000 for doing nothing. If you can build a portfolio of $10 million by the time you retire, then 10% is $1 million a year. So that's where you need to get to. And if you and your partner are working and you got good jobs, like one in IT, one in accountant, there is no reason why you cannot build a portfolio worth $10 million. There is no, if you don't think you can, please speak to us. I'll show you how it's done.
Awesome. Okay, question from Anand Kumar. Can this be run as an Airbnb as it's near a hospital?
Listen, there are a lot of new laws around Airbnb. So what I would caution first is to have a look at that. There is no reason why you can't make it Airbnb. That there's no restrictions as such, but some of the ownership and tax rules have actually changed. So again, not enough time here to go through it, but I just caution on that. The best thing to do really is to have it as a investment property and put good tenants in there. Could be nurses and the like, and just watch the property price grow.
The other thing is a strata as well. So if the strata committee doesn't allow it, especially for a more premium project like this, there's a good chance that that they may not allow it. So that remains to be seen. So all good. Okay, but thanks for that question. Right now, okay, this is from V. You mentioned having a long-term plan. What do you reckon one will be able to sell one of these apartments for a good return in, let's say, 5 years or longer?
Good question. I don't have a crystal ball, okay, but I'd like to think that by the time you settle this property, that you'd be sitting on a 10% gain, and that's very, very conservative. The 5% you will make when the 5% rebate is gone, you make that anyway. Okay. Now, is there a likelihood that property prices, they will increase the price by a further 5% between now and the time your property settles? Highly likely. 5% maybe is low. It could go as high as 10% for the last few apartments. So I wouldn't want to, apart from my earlier comment that you won't be able to buy a 2-bedroom brand new apartment in Sydney for less than $1 million by 2030. It could happen even sooner. It could be in 5 years' time rather than 7 years' time. So just have that view. The most important thing is this area is an area of growth, significant infrastructure, great development. Okay, stand out development. Tick box, tick box, tick box. The price will take care of itself. Okay, you're not paying a premium. You're buying at a discount. That's more important.
Perfect. Thank you for that. All right. Next one is from Shraddha. What do you reckon about a house in Box Hill, considering future capital growth?
Box Hill is an interesting suburb, not far from here. Next suburb, really. The Box Hill land values went up significantly in 2021. So land values went up from $500,000 for average size block to about 900,000 average size block. And now it has come down to around 750 to 780. So it has done a huge increase and then had a big correction recently. So listen, Box Hill for some reason is still very highly sought after suburb for, and if you can afford, obviously you're in a different price range to what we are presenting here. But if there is a good time to get into Box Hill, it is definitely a better time than 2021. So if you've got the money to go and buy a house, absolutely go and find a bargain. Go and find a bargain in Box Hill now for a land and build a house. So if I'm very confident that if you don't do that in the next 3 to 4 months, you will find that the prices are going to start creeping up. Okay. The Castle Group, there's a builder called Castle Group. I work very closely with Castle Group. I'm only actually on the advisory board as well, and I advise the owner on a lot of things. And I can tell you, listen, that they've already come out and said our prices are going to go up by 6% in the next 3 months. Okay. He's made a media statement last week. I can share that article with you. So he's got a lot of land holdings. He's the biggest landholder. Castle Group's the biggest landholder in Rouse Hill. So they do land developments basically. So listen, it's a good time. It's a good time for you to commit in the next 3 or 4 months. If you're waiting for the market to bottom, there is no further bottoming happening. Okay. Now people are going to say, market has bottomed. I've been waiting for the market to bottom and the tightening to finish. Now I'm going to get back into the market. Are we going to see a big jump in house and land prices? No, not a big jump. Steady. Okay. We won't see a 2021 for a long time. 2021 happened 3 times in the last 100 years. It doesn't happen all the time.
Awesome.
Hopefully I've answered your question.
Thank you.
Okay.
Thanks. Okay, this is from Shyam. So Shyam has asked, how many apartment projects are coming to Binar? How is the supply and demand will be in the near future? I can answer the first part for you, Shyam. So at the moment, I believe Binar have got 4 projects going on at present. So they're building this, they're building Q in Schofields as well. I think they're building one called the Liverpool. So there's a couple that are on their website. So they've got a massive team. And yeah, they've got a few projects on the go at the moment, which is good. In terms of future supply and demand, I'll let Sachin answer that piece.
Yeah, listen, I mean, see, you're talking demand generally, or you're talking about Binar? So, sorry,
Yeah, good question.
I'm trying to understand the question, Shyam.
In general, means on the one side you are saying means that stats are saying that in every year so many people are migrating to Australia and Sydney especially, and so many apartments are coming. So how the demand and supply will look in future?
Yeah, listen, like you saw, in a normal year in Sydney, you need 38,000 dwellings. They were the numbers that New South Wales Treasury put out, right? Those figures have been there for a while. That's based on a migrant intake of about 95,000 people. So we are going to see figures in excess of that. We are probably going to be seeing, 130, 140,000 people per year coming to Sydney. So when you've got so many people coming, we've had a pause in the construction. You saw the graph coming down on completed apartments this year and next year. The graph is actually coming down. So for that graph to actually go back up again, you need to start a lot of projects now. With the interest rate going up, we know a lot of developers also, they paused a little bit as well. They thought, okay, well, maybe not. But now there's enough indicators out there for the developers to go start their projects and complete them. So probably by the time 2025 comes and 2026 comes, we will get a lot more completed apartments. And that's when you might see some correction again coming back into the rental market perhaps. But at the moment, in the next 2 years, it is, like I said, it is the perfect storm for apartments. And people at this time are not going to be able to afford houses. House values have not come down significantly. In some suburbs where I live in Kellyville, we're still breaking records in our street. It hasn't stopped. Bella Vista hasn't stopped. Glenwood hasn't stopped. I've been to a lot of auctions in the last 2 months, and I can tell you, it does not look like a slow market. There is bidders. The market is still very strong. And the reason for that is there's a very low supply and there's very high demand. There are still a few pockets in Sydney where you might say there is a little bit more supply than demand. That will get absorbed in no time. Give it another 2-3 months. There will be no more supply. And the demand is coming from everywhere. Okay. So
one follow-up question on this thing means we expect the market demand and supply will be, there's huge demand coming, huge people are coming. So, but is the infrastructure is strong enough? I means in Marsden Park, there are so many on social media, the news comes, the infrastructure is not that much strong and still
good question.
apartments, right?
So this is
how the normal life will be of people living in there, right? So.
Listen, very good question. Very good question. The government is always lagging behind. And, I think the government and the council are starting to work together. Again, too little, too late, to make sure that the councils are not holding on to these type of projects, right? I had a meeting with the Blacktown Council mayor and the CEO of the Blacktown Council about 2 weeks ago. And they acknowledge that they are behind the yield curve, right? They're making dormitory type schools in all these suburbs now where the population has grown and there's not enough schools. The hospital project is, I think, 2 years too late. There is so much of demand and infrastructure is actually lagging behind. So you're absolutely right. But, there will be parties that will be saying, stop the migration. We can't cope. But there's a number of good reasons why they're not going to stop the migration. So the migration will continue, and something has to give at some point. I don't know how the government. That's why I'm saying this is the biggest government's issue will be this acute, chronic shortage of properties for rent and to buy.
100%.
Yep.
So Sham, very very good point, and I don't have a clear answer to that other than the government will have to act and act quickly.
Thank you.
Thanks, Sham.
Time for
Okay.
a couple more.
Yeah, there's probably about 15 more, but
That's okay. I'm happy so long as everybody else is happy to stay on.
yeah, awesome.
Now let's quickly fire away. Fire
Awesome.
through these.
Okay.
Awesome.
Next
So
one.
we've got Sojanya. So Sojanya has asked, what do you advise for first home buyers?
If you've got enough deposit or equity somewhere, somebody can give you, buy a property. Okay, you got to buy a property. The longer you leave it now, the more you're gonna pay. So at 1-bedroom apartments, if you can only afford a 1-bedroom apartment, go and buy a 1-bedroom apartment. It might cost you $520, $530, $540. Go and buy one, because that price is only going to go up. Now, at the moment, a 1-bedroom apartment, just to give an idea, if you were to buy in Macquarie, it's going to cost you $750,000 for a 1-bedroom apartment in Macquarie, and sometimes it might not even have a parking spot. So this wave, the wave catches right through the suburbs. So where Chris lives in Wentworth Point, the rents overnight went from 1-bedroom apartment rent went from $450 to $620 overnight. What are those people doing? They're moving further away. What else they're going to do? They're going to push the rental price up. So listen, this is the perfect time. Do not wait. If you've got sufficient deposit, or if you're buying off the planned property, you pay your 10%. You won't have to pay your stamp duties. And you wait, you collect more money between now and when settlement comes, and get into the property market. What you're doing is you're locking in the price by entering now. Okay, you're locking in the price. These developers have got projects. They're not increasing their prices right now. They're waiting for this demand to come. As soon as they sell 10 properties in a weekend, you watch the change of behavior from these developers. It changes overnight. We experienced this. We've experienced this. Some developers increased price 5 times in 2021. It was criminal. Okay, same project. So I would urge you not to wait. If you're a first home buyer, take advantage of the government stamp duty, take advantage of the potential grants and everything else they're giving you, and get into the property market. The longer you wait, the more you'll have to pay. Hopefully that answers your question.
Thanks, Sachin. Right. Sorry.
Thank you very much.
And again, our offer is open if you want to have a chat to us. Yeah, we're happy to spend as much time as possible as you need.
All right. Next one is Neeraj. Growth prospects about Seven Hills towards the south side.
Seven Hills is a good suburb. Has been underpriced, actually, I think, compared to its neighbors. Good time to get into Seven Hills. If you find a good buy, bargain hard. Bargain hard while you can. Yeah. But listen, there's certain things about these existing suburbs versus these new suburbs, right? So the potential for growth, in my personal view, again, it is my personal view only. For if I compare Seven Hills to this Rouse Hill area, the potential for growth in Rouse Hill is more. Okay, you got up $700,000 in Seven Hills versus $700,000 in a project like Babylon. Your potential for growth in Babylon is more. And for all of the reasons I said before, how much infrastructure is going to go into Seven Hills? Not a lot that I know of. Okay, so keep that in mind. Those things that I talked about, its location, its demographics, population growth, infrastructure, all those things, you've got to tick those boxes. But Seven Hills is still a very nice suburb. Okay, so it comes down to a bit of personal choice, right? It's a bit like the person that I say, bought the $950,000 2-bedroom apartment in Rhodes, and they're wondering why their apartment value did not go up in 2021. So I can tell you that it's a wrong price at the wrong place at the wrong time. Okay.
Sure.
Thanks, Sachin.
Brilliant. Thanks, Neeraj. Another question from V. How long do you advise that we fix our interest rates for now? 1 year at 5.5?
Listen, if you're going to fix your interest rate right now, then do not go past 1 year, please. Please, 5.5 for 1 year is okay, but it is not that far south of the variable rate. There are still some very good variable rates out there that are not too far away from 5.5, because the chances of the variable rate going up much further now is quite small. You might see 1 more quarter% and then no more. Secondly, in the second half of this year, as I said, I am predicting the fixed rates to be a good 1 to 1.5% below variable. Reserve Bank will take time to cut the cash rates. But if the money market thinks that the next move in rates is down and the bond rate, swap rate, futures rates come down, you will start seeing some really attractive rates out there. Don't rush, because that trend of lowering of interest rates is going to happen. So when it gets to 4% for 5 years, then I would say do it. We are quite a few months away from that. Could be 4 to 6 months away from that. Okay.
Awesome. Okay, so next one is from Saurav. As you mentioned, the Northwest is the fastest growing region. As a first home buyer, it's not in our reach. What other areas would you suggest for a young family, i.e. first home buyer?
So what sort of price range were you talking about?
Oh, like around 800K, I guess.
Okay. So Saurav, you're looking for a house, right?
Yeah.
Okay. It's listen, it's a difficult one because we all know that there is not a lot left in Sydney for buying an existing house for around that 800,000 mark. In late 2020, I could have sold you a house and land package in the northwest of Sydney. But there is absolutely nothing in that price range out here. So listen, that's not to say that there is nothing, but you'd have to search and you'd have to probably go a bit further. Somewhere around Warrington, perhaps, some of those suburbs, you will pick up something in that 700 to 800. But, St. Mary's has gone up a lot because metro coming close to airport. So even Mount Druitt and other areas, you start getting into some of the, should I use the word dodgy suburbs, where the prices are still sort of below that 800, where you wouldn't want to raise a family. So the choices are limited. You may look at the alternative of a townhouse and then progress to a house. But again, we're happy to take it offline and see how we can assist.
Sure. Thank you so much.
Thanks.
Awesome.
Sarah.
Thank you. Question from V. Would you recommend North or South Blacktown?
North or South Blacktown? That is a very specific question. And what are you looking to buy? Sorry, you still there?
This is from VI.
Yes, yeah. Hi.
Hi.
Sorry.
That's all right,
We're looking for a house somewhere in the area, but not sure about north or south.
Listen, it's a very specific question, and I will be very honest and say I'm not an expert for houses in Blacktown, and but certainly we can assist you in doing some research on that and giving you some feedback. But you can have a look at growth over the last 10 years, maybe in the north and the south. That might give you some indicator. But I think the important thing with Blacktown is, when we are selling apartments there, I can tell you that we make sure that the apartment is walking distance to Westfield, walking distance to the station, very close to hospital, and very close to the motorways. Those things sort of tick about 5-6 boxes for us. And then there are educational institutions there as well. So have a look at walking distance to some of these amenities, and that might sort of answer your question. That could be more north than south, I'd say.
Cool. Thank you. All right. From Zoom user, with so many apartments at present, what's your take on regional property market, wherein you can get a bigger chunk of land? As per stats, land holds value, building depreciates. So capital appreciation will happen in the next 10 years in apartments. So capital appreciation will happen in the next 10 years in apartments in Sydney versus regional markets. Your take, sir?
Good question. And we get asked a lot about regional, and we do sell in the regional areas as well. The regional areas really took off during COVID, okay, during and post-COVID. And the reason for that is people, there was a bit of a flight to safety, right? There's a flight to safety thing. There's a lifestyle thing as well. And a lot of the regional areas that did extremely well, particularly in New South Wales, are the areas that were close to the water. So, going south from sort of Wollongong and south and going up the coast, north coast, mid-north coast and so on, prices actually did creep up a lot. Now, it was driven by lifestyle change. It was driven by people accelerating their decisioning. If people thought in 10 years' time, I'm going to retire and I'm going to move up the coast, they accelerated the decision because they survived COVID. And it's like, well, this major thing happened, and now I am just going to sell and move. A lot of people moved to Queensland as a result as well. Okay, there were a lot of Victorians who were sick of lockdowns, and they moved to Gold Coast. So that pushed the prices up in the regional areas. The other new phenomena is that people could work from remote locations. They didn't have to be close to those areas. What I would caution is that time has gone. There's a few factors that cause the big shoot up in price. Now, are people still going to move to regional areas? Always, right? Mostly they are retirees that move close to the water, up the coast and down the coast. But some of these things are not necessarily the same as that period 2 years ago. What I would caution people is that first and foremost, please look for supply and demand. If population growth is not going to happen in a regional area for time to come, you're going to be waiting for price growth for a very long time. Please be selective. If you want to buy an investment property somewhere, be selective. Do your research, okay? By all means, talk to us. We are not an expert on every regional town, but we will give you some advice, hopefully, that might assist you. We were selling up the coast, 4 minutes drive to the beach. The project that's, we're not doing that anymore, but there is, you could just be more selective, okay? With investments, you never go wrong when you're close to transport, like a train station. You've got to be close to, 9 times out of 10, I'd say to people who are investors, stick with a place like Sydney. You've got so much happening here. Next 10 years, there is significant population growth here. Stick to close to a university, stick close to a hospital, stick close to transport. You will never, ever, ever go wrong. Regional areas, mining towns, please. If your 10th property, yes. Your next 5 properties, no. This is my personal advice, okay? Take risks when you've got plenty of in your portfolio. Don't take risks early in your journey. Hopefully that helps.
Thank you. Okay, so what is the future investment? What's the future investment in Hawkesbury? Again, this is from Sujit. Thanks for the question. Probably more specific. I don't think anyone in the team's too familiar with this particular one.
Yeah, listen, I can probably take that, Krish. So Hawkesbury Council and Hawkesbury Shire is probably the last part of the Northwest that is going to experience growth. So when we say the Northwest and land is going to run out in the next 7-8 years, there'll be no more land left in the Northwest, right? Let's face it. And that population growth of 250,000 people living in this precinct, that is going to happen rather quickly. So half of the Hawkesbury is actually flood prone. Even parts of Marsden Park are flood prone, okay? Parts of Riverstone are flood prone. So there is a big delta there that is flood prone, and that will never be zoned for residential. So there is very little land around the Hawkesbury area, which you've got a bit of vineyard happening. You've got a little bit further from there, Pitt Town. So there are some areas there. We've just had a once in 100-year floods, and the Blacktown Council and the Hawkesbury Council have gone red zone, red zone, red zone, which means fewer land to be released. At some point, yes, you will find growth there. If you can afford to buy closer in, like Rouse Hill, Box Hill, Marsden Park, Schofields, the areas that are still inner, I would stick to that. Okay, you will. The other factor is I don't think there is any metro going out to Hawkesbury, and that Windsor Road is going to become a nightmare, and so is Richmond Road. Those two roads are going to become a nightmare in time to come because of this population growth. And the person who raised the issue about infrastructure lagging, the infrastructure will continue to lag for the next 5 or 10 years. Okay. So I just caution that. Stay close to transport. If you can afford Rouse Hill, stay in Rouse Hill.
Awesome. Thanks for that, Sachin. Good stuff. Okay, next one is, what would be the 10-year outlook in the Leppington Austral suburbs? This is from Shabir.
Absolutely amazing outlook. Absolutely amazing outlook. Okay. Close to airport, close to Atropolis. I mean, like the Northwest, the Southwest is going to boom as well. absolutely going to boom. So you buy a house today for 950,000, 1 million, rest assured it's going to go up. It's only going to go up. So all those areas are obviously fantastic places to buy.
Yeah.
Okay.
Thanks, Sachin. Yeah, there's an
Shabir,
option for us for.
Shabir, the population is growing, like you saw the numbers. These are not my numbers, these are New South Wales Treasury numbers. So there's going to be huge growth. Austral has an issue with sewer, and the council again is very slow in putting the sewer. So half of Austral cannot be developed, and some of the developers who actually bought there might be waiting for another 5 years. But there's pressure on the councils to actually do something about it. But listen, Leppington, Austral, Edmondson Park, all of those areas, Oran Park, they've already had significant growth. We were selling, I mean, Gregory Hills and all those areas, we were selling house and land packages for 650. Now try 950 and you'll just get a small 3-bedroom house. So it's going to go up. Everything in this city is going to go up. 10 years is a long time. Everything's going to go up. It's a question of what will go up more than others. So in 10 years, I bought 5 properties. Which one's going to do the best in 10 years? That's the question you've got to ask yourself if you're an investor.
Yep. Thanks, Sachin. I'm a first home buyer, so we have an option either to go in Austral or in Leppington. So that's the choice we are making because
both are.
Yeah,
both are amazing suburbs. Listen, if you can afford in Leppington, close to station, I would go there.
Thank you. Thanks.
Welcome.
Thanks, Shabir.
And if you want us to find a property for you, we can help with that too.
We do actually have some stuff in Leppington very close to the station, Sachin. I just thought to mention that.
Absolutely, we do.
Thanks for that, Shabir.
Hey.
Krishna's got a question. First home buyer, would you suggest principal place of residence or rent vesting due to a limited borrowing capacity?
Who asked that question, sorry?
It's from Krishna.
Krishna. Hi, Krishna. So this is a very good question because I hope everybody's heard of the term rent vesting. So this is a new trend that started a few years ago where mostly this new generation, they want to live where they want to work. So we have got a lot of people renting an apartment one of my nephews is renting in Kirribilli. Lifestyle choice, right? But they can't afford, obviously, Kirribilli, and they like to walk to their work over the bridge every morning. So this is a lifestyle choice. Some people actually choose a suburb where the kids want to go to school, but they can't afford to buy there, so they rent there. And where they can afford to buy, they buy. So absolutely, there is nothing wrong with rent vesting. We can discuss Krishna, we can discuss your personal circumstances and give some pointers to you in terms of what might be best for you, and we can take that offline. But, sometimes people can't afford in Sydney and their first property might be in Brisbane and they bought a house and land package for, say, 550. So there is absolutely nothing wrong with that, or Adelaide for that matter, right? There's nothing wrong with that. And what you forego is you forego your first homeowner's grant and your stamp duty concessions and all that, right? Because you've already bought your first property as a investment property. So that's what you've got to weigh. That's the pros and cons of it. But then you want to live and work where you want to live and work. There's nothing wrong with that. What I would say to you, if you are renting, anybody that wants to rent vest, and I've been saying this for the last 2 years, Christian Raj will tell you that I've been telling people, lock your rentals for the next 3 years. Lock it in, because it's gonna go up otherwise. Okay, lock in as long as you can. I've been telling people the last 2 years, rents are gonna go crazy in 23. So if it's already going up, Krishna, I can't help you, but to try find something. If you want to rent somewhere, lock it in for as long as you can, yeah, and then you can look for a property elsewhere. But that's the pros and cons of it, yeah. Sometimes you buy something and your stamp duty can be, $25,000. So you might say, well, 25 is a big enough thing that I can sacrifice, and or I want to live in that property and see the gain and sacrifice on the distance. And then when the price goes up, then I sell it and then go do something else. So it's an opportunity at the moment that if you can buy and buy as a first home buyer, then take advantage of that.
Thanks, Sachin.
Okay.
Thanks, Krishna. Thanks, Sachin. Very good question from Anand Kumar. With the rental shortage and housing crisis, wouldn't the government pass laws so that the housing crisis doesn't deter immigrants, such as laws like stopping interest deductibility, like what they've done in the UK?
This is for foreign buyers, or this is for permanent residents?
Yeah, and would you be able to elaborate on that one?
Whose question? Sorry, Anand.
Yeah. Sorry.
Hi, Anand.
Hi. Sorry. So what I'm asking is, I'm a Kiwi, and I'm planning to move to Australia. So the reason I'm asking this question is I've got few investment properties here, and the government suddenly passed law that anything which is built after 2021 can deduct interest. Anything before that cannot deduct interest. I've got 3 properties which I can't deduct interest anymore, so I'm going to get rid of them.
Okay, so Anand, you are in New Zealand, are you?
Yeah.
And you bought properties in Australia and the New Zealand, you pay tax in New Zealand.
I'm looking to invest in Australia now because the interest deductibility, it started in UK, it has passed on to New Zealand. I think the government will start passing this law in Australia as well, just because we didn't think they will pass the law here, and they have done that because of the housing crisis.
Yeah, listen, there's been a lot of debate in past governments here regarding negative gearing and whether the governments are going to take off the negative gearing deductions, right? The only thing that has happened so far in the last 40 years that I've been here is that they have taken away the deductibility of equipment depreciation for investment properties, for second-hand investment properties. So listen, the chances of negative gearing getting impacted in this country is very, very low, actually. Negligible, I would say. I don't think we ever follow what happens in the UK, and more so, New Zealand is a very small place and generally not a good proxy to use for what might happen in Australia. So I would say there is very little risk in any of our deductions in investment properties getting impacted as a result of the housing crisis. The fact is that when you have a housing crisis, the government wants more people to invest in property, so there is more rental properties. Okay, if they take these benefits away, then there will be less investors coming into the market, and you're going to create a bigger crisis. So I don't understand the full reasoning on what has happened in the UK or in New Zealand, but I'm very confident that we would not go that way.
Thanks for your question, Anand. Thanks, Sachin. Neeraj, yes, we have answered your question. Meenakshi, what's better, an old house versus an apartment?
We might have to take that one offline, to be honest. Please contact us. We will take it offline, and talk through your specific. Like I said, if you can afford an old house, I don't know again whether it's for investment purposes or for living in, and then it depends on your personal circumstances, right? And your budget. So let's take it offline so that we don't take everybody's time, but we'd be more than happy to talk you through that and help you.
Awesome. Okay, one last question I believe we have from Manish. There's a lot of infrastructure happening in the southwest of Sydney, including the new airport. However, as compared to the northwest, price appreciation as a percentage is less in the southwest. Is this due to the demographic?
Demographic probably only plays a small part. ultimately prices will all go up, right? So there may be, like I've already given an example where in Oran Park and Gregory Hills where we were selling, and in Leppington, prices have gone up quite significantly. So sometimes it is when you don't have a choice, you're going to end up going to another suburb. It's all about affordability, but ultimately prices do go up. In some places it might go up 30%, in some places it might only go up 15%. But ultimately that southwest area, which probably has much more land than the northwest to develop, we will experience growth. So northwest has probably had a sharper jump in prices, and that's because there is fewer to choose from. There's just less land. And because the rezoning has been happening really, really slowly by the councils, that is causing a big shortage in land as well. So ultimately, demographic, yes, it's, sometimes it is demographic, sometimes it is the schools, sometimes it is other factors. Ponds is a good example of a suburb where people want to live there because they want to send their children to the schools there. And the only reason why the school at Ponds is highly sought after and the only reason why its reputation and results have gone through the roof is because there are a lot of Indian population that lives there, and they send their children there, and then the reputation of the school has become better. So it's just one of those cycle things. The same thing happened in Wentworthville, I think, with the primary school there. So there are a number of factors. But there is nothing wrong with the southwest of Sydney, and it is going to get growth as well. But there's it's about your personal situation and what you can afford.
Perfect. Thanks, Sachin. No question from Vanya. Two questions have couple of questions have crept in. House in Perth versus an apartment in Sydney. What would you choose in terms of capital growth?
Listen, Perth is a big city, quite a nice city. There is a lot of the prices there are very stagnant at the moment. I think one of the things I find about Perth, and I personally have invested there as well, is that the price growth there is very volatile. Okay, so it's been a big boom during the mining investment. And then there was a bit of a huge correction. At the moment, what is fueling the price growth there is the shortage of properties for rentals. And population growth-wise, and infrastructure-wise, any day I would pick Sydney. So in my last 40 years of investing in Australia, right, I've invested in other states as well, quite a lot in Southeast Queensland. I will say one thing from my learnings over the last 40 years. If I had bought all my properties in Sydney and nowhere else, I would be significantly better off today. Significantly. Okay? Significantly. I mean, I can't put it'd be millions of dollars. Okay? So you've got to have growth. That's why I say demand, population growth, infrastructure, all these things are so important. I can't overemphasize. So don't look at regional. Don't look at a bargain in some of these areas, okay? If you can't afford Sydney and you need to go buy there, and you find a good area of growth with good returns and good demographics and so on, and it ticks the 9 boxes or 10 boxes, then do that. But if you can afford Sydney, please stay with Sydney. This is going to be a big city. Okay.
Thank you. Okay. Next one, or this would be the second last one from Zoom user. I believe this question has just been answered. What's your view on Tamworth and Inverell in regional New South Wales in terms of capital growth for investors? And you just answered that quite passionately. Sorry.
Listen, I don't have anything against regional, but I'll say it again. Please do your research. Please see the population. The population growth by postcode is available in the New South Wales Treasury website. Go and do that research. If you want us to do it, we'll do it for you. Okay. So it tells you now 2036 what the population will be in a postcode. Okay. How many people per home will be living there? All these numbers are done by the analysts in the New South Wales Treasury. And so we use that research to actually tell people. But we don't research every suburb, obviously, but do your homework, please. You don't want to buy something and then be stuck with it and say, well, 10 years later, and you say, well, I should have bought in Sydney. Should have listened to that old bald-headed guy. Okay.
All right. Then this is the last question. Quakers Hill versus Marion versus Marsden Park. What's the best suburb to invest for an established house?
Which suburbs again? Marsden Park?
Marion and Marsden Park.
Marion and Marsden Park. Which is a good suburb to buy in?
Quakers Hill, Marion, or Marsden Park. If you're going to buy an established house, which
Marsden
one?
Park. Marsden Park. I would pick Marsden Park. There is just so much infrastructure going on there. And I think you're going to see you probably are going to see a metro there that's going to go to the airport.
The demographic area.
And demographic is definitely better than Quakers Hill. Nothing against anybody that lives in Quakers Hill. Excuse me for saying that. But Marion is a poor cousin. If you can afford Marsden Park, go for Marsden Park.
Yep. And then last one, is it a good time to sell your property? From Dinesh.
Dinesh, what sort of property are you looking to sell? If you can unmute, Dinesh, what sort of property you're looking to sell?
Apartment.
Apartment. Can I ask where it is? It is?
Inner West.
Inner West. Don't sell.
All right.
Okay. If you listen again, it's a straight question and a straight answer, which is not really fair, because what I should be asking you, Dinesh, is what are your circumstances? What are you going to do with that money? Are you going to invest into something else? What will that investment be? So there is all those questions I need to be asking you. But generally speaking, if you want to sell a property, and you can hold on for another, if it's an apartment particularly, if you can hold on for another year, I would hold on. Yeah, rentals are going to go up. There's more people coming here. Listen, you don't have to be a rocket scientist to know that you're sitting on a good asset. You're in Inner West. It's a good suburb, and you're going to get growth. But if you're selling that to buy something else, then it depends what that something else is going to be, and so on. But don't just sell your property and leave the money in the bank. That's the last thing. That's the last thing you got to do. Okay.
All right. Now I'm thinking to use the equity and get maybe 2 more.
Yes, you can do that. So I say to people, right? If you sell a property and you've got some equity to buy, you can buy 2. How you can buy 2 is do your homework, talk to your mortgage broker, but you might be able to put a 10% deposit on one that settles end of next year, and you might be able to put a 10% deposit on one that settles in 2025. Right?
Yeah.
So you gotta think when you're building, and I've done this many times, when you're building a portfolio, it's not like going to the bank now and saying, can I buy 2 houses, please? Bank will say no. You don't have to tell the bank now that you're paying 10% on something that finishes in 2020. We've got projects finishing in 2026, right?
Yeah.
But a big caution here, make sure that you can back yourself, that you will still have a decent job, that at the time that you've got to do settlement, you can actually borrow the money. I will never advise any of you to overstress yourself so that when the time comes, you won't be able to borrow the money and you lose your 10%. That is the worst thing that can happen to anybody. Okay.
Thank you.
You're welcome.
Thanks, Nish. No, guys, that's the last of the questions. And Sachin, thank you so much for answering all them.
Thanks for your time. I've gone well over time, but I we are available to have a one-on-one with you anytime to help you in your property journey, right? I have a passion to help people accumulate wealth through property, and I mean that. Thank you all for listening.
Thank you.
Thank you so much, Sachin. Thank you, everyone. Thank you so much.
Bye.
Thanks, Sachin. Thanks, everyone.
Thank you.